Hey guys, welcome to Make Money Count. Today we're going to be talking about the CPI numbers and if we're going to get a rate drop. Are we going to get a rate drop?
Yes. You saw the CPI numbers?
I did. Low.
No, I mean, okay. So far, we understand that when the CPI numbers come out, we have to look at kind of two factors,
Right.
two parts of Statistics Canada's release.
Right.
Number one is the kind of overall CPI number, which appears
To be low.
to be 1.7%, kind of in the range of what the Bank of Canada wants. Very much a number that implies that we are below the 2% threshold for the Bank of Canada for the growth, and therefore that the Bank of Canada should drop rates.
Right.
The problem is that the Bank of Canada reads core CPI.
Right.
We've talked about this at length, ad nauseum, on this exact channel. Basically, the tightened core items in the CPI basket, removing the items that are fluctuating too much in a given month, helps the Bank of Canada derive a number for inflation that they feel is more accurate.
Okay.
And those numbers, although they're a little bit lower than they were in the previous month, are still at the top of the allowable range.
Right.
When the numbers came out, every economist started to change their forecast for interest rate drops for the Bank of Canada.
Okay.
Unfortunately.
Mhm.
And the theory behind that is that the Bank of Canada will be reluctant to drop interest rates in the face of what is still somewhat elevated inflationary pressure.
Right.
I believe that we get one more inflationary reading because the next Bank of Canada meeting is July the 30th. I think we're going to see not a ton come off of the CPI, the core CPI numbers, but I think we're going to see a lower print on it.
Mhm.
And I think that as a result, we're more likely to see the Bank of Canada drop rates by 25 basis points in July, which won't really do anything, but will serve as a bit of a signal to the market that the Bank of Canada is aware of the pain in the market. And that pain is kind of like further down the line, right? Like it's in the employment numbers, it's in the consumer confidence, it's in consumer spending, because we're definitely seeing consumer spending tighten. Consumer confidence is very low. Unemployment is the employment market is very soft right now, and it's only getting softer.
Right.
With all of the trade uncertainty. In the Bank of Canada's kind of perfect world, they would see trade certainty come back into play with a deal between Canada and the US, which is looking
Very good.
like more likely now.
Yeah.
Carney is at the NATO meeting. He's making friends with everyone in Europe.
Yeah.
You know, I think that
I mean, it sounds like we're going to have to spend more on military.
which is what we needed. But think about it, right? Spending $50 billion more on military spending is going to save us that money that we would have had to dole out to Canadians just to support our economy in the event that we went on a full-blown trade war with the United States.
Right. Yeah. 100%.
And the things that we've done to prevent that full-blown trade war, like paring back our tariffs on the United States to eliminate tariff impact on inflation numbers. We've got a Canadian dollar that's strengthening. All of these variables, all of these actions that we have taken have resulted in lower inflation than we could have possibly seen, and less damage to our economy than we could have possibly seen.
Right.
So we're navigating it really well.
Yeah.
And I think that part of that navigation, if we really want to see us, like we're in a recession, but if we really want to see a kind of quick recession and
Soft
a quick
landing.
way out of it,
Yeah.
I think a big part of that's going to be to see 25 basis points come off of the rates in July. And I still think we're going to see it. I think the probability of it, like, just so you know that we're taking a bit of a flyer here saying 25 basis points off July 30th, because I think it's like a 28% probability now in the market that we're going to see a 25 basis point
Right.
drop. And again, the fear is just that the Bank of Canada does not want to be seen as taking inflation lightly because they've done it once in the past. However, and we've spoken about this too, just remember that in order for inflation to become entrenched in an economy, the labor market has to be tight. And we don't have a tight labor market. There are no jobs. There are people that are extremely qualified looking for jobs. There are students that are coming out of university that for them, unemployment is at close to 15%. So there are significant fissures in the Canadian economy, and those will grow into fractures if we do not address in some small, meaningful way the cost of borrowing. There's a quick chart I saw from a realtor that does a ton of great work. I'm going to put it up right now. And it just shows the number of canceled listings at like a 10-year, 15-year high. I don't know. The data doesn't go back that far. But as you can see here, like this is, so we're in an environment where there are more listings than ever, and more people are canceling their listings than ever. And there's a bit of a strategy to it. People want to like list it and then they want to take it back off because there's no action.
Yeah.
So then they'll list it again in order
Lower.
to kind of refresh it in the hopes of getting some action. All of this is to say is there is no action. And the amount of the Canadian economy that is reliant on real estate, when real estate goes to zero, effectively zero is what we're seeing right now. In order for that to get resurrected, we're going to need to see lower borrowing costs. There is nothing else that will do it. Property values are dropping. Property values seem to be kind of holding, but they're holding on no volume. And if volume comes back into the market, it's going to mean a drop in pricing. And if rates don't decrease, that drop in pricing will just get worse as more desperation comes into the market, more properties are listed. It could be real trouble, especially with the unemployment rate where it is and confidence eroding. It will further erode confidence. So we're in a really delicate position here. I think we have to kind of take core CPI at a slightly lower print, which is what we got last month for last month, as a sign that it is abating and that it is nowhere near where it was and that it is not creeping higher, because it's going to be contained by wage growth, which is unemployment, and confidence and spending. So there you go. CPI prediction, result of the CPI, my prediction is we're going to see 25 basis points July 30th. We will have a few opportunities to speak in between now and then. There will be more numbers coming out between now and then. There's going to be more unemployment numbers. There's going to be more confidence numbers. There's going to be more damage in the real estate market. We are going to hopefully go into a kind of slow, easy summer of real estate transactions. And I don't think we're going to see some precipitous drop in real estate prices right now because we don't see 25 basis points. But we need the Bank of Canada to signal to the market that they understand the pain and they do not see inflation as coming back in. And I think we're going to see that.